This is Insurance Simplified, and in this video, we will talk about insurance. What is an insurance contract? Who are the parties to an insurance contract? And what are their obligations to one another? Let's begin. What is insurance? Insurance is a contract or agreement whereby one undertakes for a consideration to indemnify another against loss, damage, or liability arising from an unknown or contingent event. Let's dissect this definition. First, it is a contract or agreement. And because it is a contract or agreement, it requires consent by two parties who are presumably legally capacitated to enter into a contract. And their consent must be over the object and the consideration. Next, one party, called the insurer, undertakes to pay an indemnity to the other party for loss, damage, or liability. Clearly, the object of insurance is the payment of indemnity for loss, damage, or liability. Next, the loss, damage, or liability arises from an unknown or contingent event. It cannot be intentional or planned. Lastly, the other party undertakes to pay a premium, which is the consideration in exchange for the promise of the other. So when does a contract of insurance take effect? Contracts generally take effect when there is an agreement, meaning consent, as to the subject matter and the consideration. This agreement can be verbal or in writing, and the consent may be expressed or implied. But that is for contracts in general. Under the insurance code, however, the insurance contract takes effect only after the payment of the first premium. No first premium, no contract of insurance. The rule, however, is different in case of subsequent premiums because there are exceptions. In the case of subsequent premiums, the same can be paid within the grace period as provided under the law and as provided in the policy. So in insurance contracts, it requires both agreement and payment of premium. So who are the parties to an insurance contract? First, the insurer, the person who undertakes to indemnify another by a contract of insurance. Next, the insured, the person indemnified or to be indemnified. Third, the beneficiary, the one whom the insurance is payable or who is entitled to the proceeds of the policy on the occurrence of the event designated. Note that in reinsurance contracts, the reinsurer is the person who undertakes to indemnify the insurer. Clearly, the insurer in the original policy becomes the insured in the reinsurance contract. Let's illustrate. This is a video explaining the parties to an insurance contract. I want you to meet Ray. Ray is a Jedi. Also, she is a mother. I want you to meet Bob. Bob is Ray's son. Now, while Ray is fighting bad people, she is risking her life, and she could die. And if that happens, Bob will suffer a terrible loss because Ray provides Bob his support, needs, and expenses. So what Ray can do is get a life insurance policy with the Stormtrooper company. Under the life insurance policy, in case of Ray's death, the Stormtrooper company will pay Bob a certain amount or indemnity as agreed upon in the policy. So Ray is the insured because she is the party who took out the life insurance policy and whose life is insured against death. The Stormtrooper company is the insurer because it is the party who undertakes to pay an indemnity in case of the insured's death. Bob is the beneficiary because he will receive the benefits or the proceeds of the insurance policy. Now assume that everyone in the Star Wars universe is insured by the Stormtrooper company. And assume further that everyone who is insured by the Stormtrooper company dies. This can overwhelm the Stormtrooper company and may result in defaults. So what the Stormtrooper company can do is get a reinsurer. Enter Frozone. Now Frozone as a reinsurer will pay the Stormtrooper company in case the Stormtrooper company becomes liable under the policies that it issued to its insured, including Ray. So that will make the original insurance policy valid, effective, and paid for. So that is your short explanation of the parties to an insurance contract. So, when is the insurer liable? First, the insured must be exposed to some risk or peril. Let's look at some examples. So you have three different insured and three different risks or perils. A person is exposed to the risk of death. An owner of a motor vehicle is exposed to the risk of damage to his motor vehicle. A restaurant owner, on the other hand, may be exposed to injury or damage to customers. Second, the risk or peril must be due to some specific incident or event. So, remember the person who is exposed to the risk or peril of death? Let's say the policy stipulated a specific cause, and that is COVID-19. For the owner of a motor vehicle who is exposed to the risk or peril of damage to his motor vehicle, let's say the policy stipulated a specific cause, and in this case, flooding. For the restaurant owner who is exposed to the risk or peril of injury or damage to customers, let's say the policy specified a cause, and that is food poisoning. So, the specific cause is now identified. So, for the insurer to be liable, he must agree to pay the insured for the loss or damage contemplated, provided it is due to the specified cause in the policy. So, let's take the example of the person and the restaurant owner. The person who is exposed to the risk or peril of death and the specific cause in the policy is COVID-19 dies of COVID-19. So, the insurer is liable. Now, the restaurant owner who is exposed to the risk or peril of injury or damage to customers, and the policy specified a cause, and that was food poisoning. However, the cause of the injury or damage to his customers was a falling ceiling. In this case, the insurer is not liable. Why? Because the cause of the injury or damage is not that which was specified in the policy. Now let's talk about premiums. An insurer is entitled to payment of the premium as soon as the thing insured is exposed to the peril insured against. This reiterates what we said earlier, that the payment of premiums is mandatory. The premium is the reason for being of the insurance contract. Without the premium, the insurance contract is invalid and non-binding. So, many of you may be curious, can the insured recover the premiums? As a general rule, no. The premium is the consideration for the insurer to take the risk of indemnifying the insured. The insured is paying the insurer for his promise to pay in case of loss, damage, or liability, whether or not the loss, damage, or liability happens. In other words, the insured pays the insurer for the security that when the loss, liability, or damage happens, the insurer will pay him. But in some cases, the premium may be returned. And these are some of the examples. So first, when the insured person or thing was never exposed to the risk or peril. Remember our example on the restaurant owner? Let's assume the restaurant owner obtained the insurance before he constructed his restaurant. And after that, his plan to put up a restaurant never materialized. So clearly, the restaurant owner was never exposed to the risk or peril of possibly causing injury or damage to his customers. So in that case, there is no reason to proceed with the contract. The contract can be terminated and the premiums returned to the restaurant owner. Next, when the insurer is guilty of fraud. So here there is a breach of contract on the part of the insurer. So the contract will be terminated, and the insurer, if he received the premiums, he must return it to the insured. Next, when the insurance is for a term and the insured returned the policy before the expiration of the term. Now this one applies only to non-life insurance, meaning property insurance. So here, when the insured returns the policy prior to the expiration of the term, the return of premiums will be computed based on the unexpired term. Okay? And lastly, in case of overinsurance, here the return of premiums is based on the excess of the value of the property which was insured. Okay, so that's all for premiums. Now, on the last note, I'd like to say that everyone in insurance must act in good faith. And honesty is the best policy, both for the insurer and the insured. Full disclosure by both parties is important. On the part of the insurer, full disclosure of all circumstances or incidents involving the business, such as license, permits, and the authority to operate. And on the part of the insured, all facts material to the subject matter of the insurance, such as the health of the insured person, and also all conditions affecting the insurability of the property subject of the insurance. And lastly, faithful compliance by both parties with their respective obligations. On the part of the insured, it's the timely payment of premium. And on the part of the insurer, it's the prompt payment of indemnity. You see, when both parties comply with their obligations faithfully, then insurance can serve its purpose, which is to provide security for the insured and of course to provide income for the insurer. And that ends our video on insurance. I hope you learned something today. If you have some questions, comments, suggestions, please comment down below. I'd like to read your thoughts. Let's interact. As always, thank you very much for watching and see you in the next video.